Margin alert. Silver lockout. Next 24 hours. Silver isn't moving today, it's lunging. And when silver starts lunging, the chart becomes the surface, while the plumbing underneath becomes the story. Because this is the kind of tape where silver can look unstoppable in the morning, dump hard in the middle of the session, and then snap right back like the drop never happened. That pattern is not random. That pattern is pressure. Here's your promise for this update. In the next 24 hours, I'm going to show you the one mechanism that can whip this market around, even when headlines are quiet. The one retail signal that screams stress without needing a price forecast, and the exact checklist to keep you from getting blindsided by a mechanical flush. Now, quick note before we continue. This is educational content, not personal financial advice. Manage risk, size positions responsibly, and if you want sharp, no fluff silver updates on days where every hour matters, hit subscribe and turn on notifications. This channel is built for moments like this. All right, as this update goes out, front month silver is trading in the mid-90s zone after tagging fresh record territory. With an intraday range that's wide enough to tell you one thing, silver is not in normal mode, it's in risk mode. And in risk mode, there is one word you respect more than any rumor, more than any tweet, more than any target price someone shouts online. Margin. Not because margin is exciting, because margin is mechanical, and mechanics don't care about your opinion. What changed over the last days? The main futures exchange for precious metals shifted how it calculates margins for metals contracts. Instead of treating margin like a fixed dollar toll, it moved toward a percentage of notional value. In plain English, the hotter the market runs, the heavier it becomes to carry paper positions. That is the quiet killer. It doesn't trend, it doesn't go viral, but it shows up in the behavior you can see with your own eyes: sharp flushes, sudden air pockets, violent snapbacks. So today's margin alert is not a catchphrase, it's a description of the environment. The mechanism in 60 seconds. Let's make it concrete. A standard COMEX silver futures contract controls 5,000 ounces. At roughly $95 an ounce, that's about $475,000 of notional exposure. Now here is the part most people never internalize. A notional-based margin system doesn't only ask, are you right? It asks, can you afford to stay in while you're right? If the margin framework is around 9% of notional for standard risk profiles, then the collateral burden rises automatically as price rises. 9% of about $475,000 is roughly $42,750 per contract. And that's before you consider that brokers can impose stricter requirements than the exchange. Requirements can differ by account type, volatility, and internal risk. So treat margin like a moving ceiling. When volatility rises, that ceiling drops. And when that ceiling drops quickly, forced behavior appears. That's where the flushes are born. Not because the world stopped needing silver, not because the bull case died, because collateral got heavier. The signal most people miss. Now, if you want to pattern your thinking like a risk desk, you need two screens. Screen 1, price. Screen 2, access, because price can be slapped around. Access is harder to fake. And today, one of the cleanest access signals came from a major retail dealer, a temporary minimum order threshold on online orders, implemented specifically to manage volume and backlog. Read that again. In plain terms, demand pressure got so intense that the system had to throttle the flow. That doesn't mean no silver exists. It means the pipeline is stressed enough that normal retail behavior is being rationed. And rationing is a word you don't ignore. If you've watched this market long enough, you know the pattern. First, you see unusual back orders. Then you see longer shipping windows. Then you see purchase limits or minimums. And then, if the pressure persists, you see premiums detach from paper. That's why today isn't only about a number on a screen. It's about how the real-world pipes are behaving. If this is landing for you, type steady in the comments right now. Not as a slogan, as a reminder that your edge is staying calm inside volatility. Why the mid-90s matters. A multi-percent day in silver at these price levels is not a normal day. It's a statement. It usually means a mix of three flows are colliding at the same time. 1. Momentum buying. Late buyers chasing the breakout. 2. Hedging and rehedging. Options desks adjusting exposure as price rips through key zones. 3. Forced risk reduction. Positions that made sense yesterday don't fit today's volatility profile, so they get cut. When those three flows overlap, you get the signature pattern. Surge, dip, snapback. Surge, dip, snapback. And here's the crucial point. In a margin-sensitive market, A dip is not automatically bearish. A dip can be mechanical. That's why you don't trade emotion. You trade behavior. The macro backdrop without the noise now? Yes. There's a bigger backdrop feeding this move. Gold has been ripping to fresh highs, the dollar has been wobbling, and rate cut expectations keep pulling capital toward hard assets. Add geopolitical tension and tariff talk, and you get a market that wants protection. But here's the trap. If you anchor to the macro story alone, you'll miss the micro trigger that actually whips the tape. Macro is the weather. Margin is the steering wheel. Weather sets the mood. The steering wheel decides the turns. So treat the macro backdrop like fuel in the tank. Important. But not the thing that explains the sudden swerves. If you want a simple way to think about it, it's this. When money is nervous, it looks for metal. When the move gets too fast, the exchange and brokers look for collateral. And when collateral rules tighten in the middle of a stampede, you get violent shakeouts that feel personal, but are mostly mechanical. That's why you don't need 20 narratives. You need one clean lens. Mechanics. Late buyers chasing the breakout. 2. Hedging and rehedging. Options desks adjusting exposure as price rips through key zones. 3. Forced risk reduction. Positions that made sense yesterday don't fit today's volatility profile, so they get cut. When those 3 flows overlap, you get the signature pattern: surge, dip, snapback. Surge, dip, snapback. And here's the crucial point. In a margin-sensitive market, a dip is not automatically bearish. A dip can be mechanical. That's why you don't trade emotion. You trade behavior. The macro backdrop without the noise. The 24-hour alarm desk checklist. I'm going to give you the checklist you can run every day in under 1 minute. 3 checks. That's it. Check 1. Where is silver trading and how violent has the last day been? Today, silver is holding the mid-90s after extreme movement and a wide intraday range. Translation: elevated volatility with intention. Check 2. What is the risk environment? Today, risk is elevated. You can feel it in the speed of reversals. Translation: leverage is a bigger factor than usual. Check 3. What is the mechanism that can flip a strong move into a sudden flush? Today, notional-based margin pressure plus liquidity gaps. Translation: the next surprise will likely be mechanical, not narrative. Those 3 checks are how you stop getting shocked. Now, let's map the next 24 hours into 2 realistic pathways. Not prophecy, recognition. Pathway A, the leverage flush. This is the scenario where silver tries to extend, then gets hit with a sharp drop. That looks ugly on a chart, but is mostly mechanical. Why does it happen? Because as price stretches and collateral demands rise, multiple participants reduce risk at the same time. It's not a vote on the long-term thesis. It's a forced reset. In this pathway, you'll see 3 signatures. Signature 1, the drop is faster than it should be. Signature 2, heavy selling into the dip. Then a sudden slowdown, like the selling ran out of fuel. Signature 3, a recovery that is annoyingly quick, because once the forced selling is done, there aren't enough willing sellers left. Pathway B, the grind and go. This is the scenario where silver consolidates near the highs, pullbacks stay shallow, and each dip gets bought quickly. Why does it happen? Because the market is absorbing supply without panic. Buyers are strong enough to defend levels. In this pathway, you'll see pullbacks that last hours, not days, a tightening range, then a push that clears the next level. Both pathways are consistent with a hot market. The difference is behavior, not narrative. Your quality filter. Here's a simple filter that separates a healthy rally from a blow-off. A healthier rally tends to show higher lows, pullbacks that don't erase the prior push, candles that close strong instead of leaving long panic wicks. It feels tense, but controlled. A blow-off phase often shows straight-line spikes, sharper pullbacks, gap-like jumps where levels get skipped. It feels exciting and dangerous because it can reverse violently once the last buyer is in. So you're not only watching direction, you're watching the quality of the move. The 3 moments that can flip the tape. Moment 1, thin liquidity windows. Silver is global, but it doesn't trade with equal intensity every minute. In thinner moments, price can travel farther because there's less resting size on the book. Moment 2, the cluster run. When a hot market knows where the crowd is positioned, it can tag those levels, trigger stops, and then reverse. That's why you sometimes see a scary move that lasts minutes, followed by a snapback that lasts hours. Moment 3, margin sensitivity itself. When the market is priced like this, every push higher increases notional exposure. That can tighten requirements. The tape can look like it's possessed. It's not possessed, it's reflexive. Options, hedging simplified. Let me explain one thing that makes these moves look unfair to the average viewer. Options, hedging. When price runs through key strikes, hedging flows can amplify the push. Buying pushes price higher. That higher price increases hedging needs. That pushes price higher again. It's a loop. And when the loop stalls, it can reverse. Hedges get adjusted. Futures selling appears. The tape whips. So don't be shocked by the violence. Understand the engine. Now, if you want me to post these alarm desk updates daily when silver is in risk mode, type 1 in the comments. If you don't, type 0. I read those, and it tells me what to build more of. What to watch specifically in the next 24 hours. Watch point 1, the speed of pullbacks. Slow pullbacks usually mean orderly profit taking. Fast pullbacks often mean forced risk reduction. Watch point 2, what happens after the first big dip. If silver bounces hard and holds, the dip was likely mechanical. If it can't reclaim key areas and keeps bleeding, it's deeper clearing. Watch point 3, range compression versus range expansion. Wide range equals stress. Compression after a hot move often equals coiling. Watch point 4, the two-step recovery. In hot markets, recoveries often come in two steps. A fast bounce, then a pause, then continuation. If you only watch the first bounce, you think it's over. If you watch the second step, you learn whether buyers are real. The retail lockout signal. Now let's return to the access side, because this is where most people miss the bigger message. When major retail dealers introduce temporary minimums or throttles, it's not because they suddenly dislike business, it's because demand and processing volume are colliding with capacity. It's a pressure valve. And here's why that matters. When demand is so strong that dealers have to protect their pipeline, it often means the public is showing up late, all at once. Late crowds don't move gently. They stampede. And when crowds stampede into a market where margin is tightening automatically, you get a recipe for violent, emotional swings. Up hard, down hard, up hard again. That's the environment. The two-rule reset. 2 rules for markets like this. Rule 1, don't make decisions in the same emotional minute as a big candle. Let it close, let the dust settle. Rule 2, separate long-term belief from short-term timing. A strong thesis can still come with brutal swings. If you're over-leveraged, volatility doesn't feel uncomfortable. It becomes fatal. So the real message today is simple. If you are trading paper silver with leverage, do not pretend this is a gentle market. Respect position size, respect risk, respect the mechanism. The map for the next 24 hours. Over the next 24 hours, silver is likely to do one of 2 things. Either it extends higher, then flushes mechanically, then snaps back, or it compresses near highs and breaks again. Both are consistent with a margin-sensitive market. So your job is not to guess. Your job is to watch which behavior shows up first, and the key signal stays the same. Does the market recover quickly after stress, or does it stay stressed? Quick recovery suggests strength. Persistent stress suggests deeper clearing. One more advanced signal. Keep your eye on the futures curve. In a calm market, future months usually trade at a premium to spot. Storage, insurance, and financing cost something. But when metal is scarce right now, that relationship can tighten. Near months can get bid. Front contracts can behave like the market is paying a right now premium. That is not hype. That is a warning light that the pipeline is stressed. Also, watch delivery behavior. In normal times, most traders roll forward without drama. In stressed times, more players stay tight to the front month. They want now, not later. They want bars, not promises. And when enough players do that at the same time, the exchange has to manage the pressure with the tools it has. One of those tools is margin, which brings you back to today's headline. Margin alert. Mechanics first, stories second. Here's the mindset shift that changes everything. Mechanics move first, stories follow. When silver flushes in this environment, don't ask, what headline caused it? First ask, what mechanism forced it? Margin, liquidity, stops, hedging. Then, after the dust settles, the stories arrive. That is how you stay ahead. Closing. Your action plan. Let's land this with a plan you can actually use. Do not get hypnotized by one candle. Watch the next few hours of reaction. Respect volatility. If silver is swinging dollars, treat it like a hot market. Watch behavior, not narrative. Mechanics move first. Access signals, confirm stress. And if you want me to keep posting these alarm desk updates so you're not blind when silver gets violent, do 3 things right now. Hit subscribe, tap like, because it helps this channel reach more silver watchers, and comment one word, steady. Because the people who win in markets are not the people who feel the most. They're the people who stay steady when the tape gets loud. I'll see you in the next update. And remember, when silver moves like this, The chart is the surface. The mechanism is the story.